Last time, I laid out the structure, the Strait of Hormuz, Morgan Stanley's final phase call, the Clarity Act's narrowest legislative window, XRP's supply compression, and crypto's decoupling from the traditional risk-off playbook during the single highest stress geopolitical event of the year. That was the setup. Today, I want to talk about what actually happens next. Not the version where you pick a price target and draw a line on a chart. The real version, the sequence of events, the mechanics, and the specific triggers that move this from a structural setup into a structural resolution. Because the most dangerous moment in any well-constructed thesis is right after you've understood it. That's when most investors stop watching and start waiting. And that's exactly when the signals that matter most are beginning to surface. So stay with me. Because what's developing right now, in the days after crypto proved its resilience during maximum geopolitical pressure, is not a cool down. It's an acceleration. And the investors who understand what to watch for are going to see it coming before the headlines catch up. Let's get into it. The first question, everyone is asking wrong. The question most people are asking right now is, when does XRP pump? That's the wrong question, and I want to explain precisely why, because the distinction matters more than the answer. The question that actually produces useful information is this: what is the sequence of catalysts that closes the gap between XRP's current price and its structural value? And what is the trigger for each step of that sequence? When you ask the first question, you're asking for a prediction, a date, a number, and predictions about exact timing in markets that are being influenced by geopolitical events, legislative calendars, and institutional rotation decisions. Those are low-probability exercises dressed up as analysis. When you ask the second question, you're asking for a map, a sequence, a set of conditions, and that is something you can actually track in real time. So let me give you the map. Step 1. The stock market has to finish what it started. Morgan Stanley called the final phase of correction. That phrase carries more weight than most people initially gave it. Here is the mechanical reality of what the final phase of a correction actually looks like. It doesn't end with a single green day. It doesn't end with a headline saying, "Correction over." It ends with a period of volatile, choppy, directionless price action, often called a base, during which institutional capital quietly rebuilds long positions while retail investors either sell in frustration or stop watching entirely. The final phase is not the last leg down. It is the accumulation phase at the bottom, and by the time most investors recognize it as a bottom, the institutions are already positioned. Here is where crypto fits into that picture. The fact that Bitcoin and XRP held, and in some cases rose, during the equity sell-off associated with the Hormuz shock is not just a data point. It is a fundamental repositioning signal for institutional allocators who are watching with real money on the line. If crypto is decoupling from equities during risk-off events, it is no longer behaving as a high-beta extension of the Nasdaq. It is beginning to behave as a separate asset class with its own supply-demand dynamics and its own macro narrative. The significance of that for institutional portfolio construction cannot be overstated. When a major asset class demonstrates it is uncorrelated from existing portfolio holdings during stress events, institutional allocators treat it as a diversification tool, and diversification tools get allocated to for structural reasons, not speculative ones. The implication: as the stock market completes its final correction phase, institutional capital is not just going to rotate from cash into equities. A meaningful portion of that rotation is going to go into assets that demonstrated uncorrelated resilience, and the two most visible examples from the Hormuz stress test were Bitcoin and XRP. Watch the equity market base. When stocks stop making new lows and begin a sustained period of choppy sideways movement at the bottom, that is your first confirmation that Step 1 is completing. Step 2. The Clarity Act either passes or the window closes. I want to be unusually direct about this because the honest version of this analysis requires acknowledging both outcomes. The Clarity Act passing would be the single largest structural catalyst in XRP's history. Not because of immediate price action, because of what it unlocks in the 90 to 180 days that follow. Here is the sequence that follows a Clarity Act passage broken down mechanically. Day 1 to 30. Regulatory interpretations are issued. Custodians begin updating compliance frameworks. Legal teams at major financial institutions begin converting internal assessments into action plans. Price may move modestly or barely at all. Day 30 to 90. The first wave of institutional custody transitions begins. Regulated entities that were holding digital assets in informal or unregulated structures begin migrating to compliant custody solutions. This is the supply compression I described in detail previously. It begins accelerating in measurable ways during this window. Day 90 to 180. The first institutional products built on clear legal foundations begin launching. Payment service providers begin integrating XRP ledger rails for cross-border settlement under a defined legal framework. The utility demand layer begins stacking on top of the investment demand layer. That sequencing matters because the investors who are watching for a Clarity Act pump on day 1 and don't see it will conclude the legislation had no effect. The actual mechanism is delayed, structural, and far more powerful than a single-day price reaction. Now, for the honest version. If the Clarity Act does not pass in this legislative window, and prediction markets currently show a 53% probability of a Democratic midterm sweep that would effectively kill this bill, the timeline extends by 3 to 5 years at minimum. That does not mean XRP loses its structural value. It means the institutional adoption timeline extends significantly, and that requires a different investment posture. Longer time horizon, more tolerance for volatility, more dependence on organic utility growth through the XRP ledger rather than regulated institutional adoption as the primary driver. Both outcomes are navigable. Neither is a surprise if you're watching the right indicators. Watch the Senate Banking Committee calendar. Watch cloture vote counts. Watch statements from senators on the Banking and Finance Committees. The legislative signal will come from procedural moves, not from the headline news cycle. Step 3. The geopolitical situation is doing something unexpected. The Strait of Hormuz closure was a shock, but what follows a shock is often more structurally important than the shock itself. Here is what is happening right now in the global financial policy conversation that almost no retail investor is tracking. Every finance minister in every BRICS nation, every central bank governor in every country with meaningful trade relationships with Iran, every treasury official in every country that has recently experienced swift disconnection or dollar-denominated settlement disruption, every single one of them just watched the same live demonstration. A single waterway, a single geopolitical decision. Entire global energy and payment systems disrupted within hours. The private conversations happening in finance ministries around the world right now are not about whether to reduce dependence on dollar-denominated correspondent banking. Those conversations were already happening. They're now about how quickly and through what mechanism. The accelerant here is critical. This is not a slow-moving theoretical risk anymore. It happened, in real time, on every screen, to every market simultaneously. The XRP ledger is the only existing infrastructure that meets every requirement these conversations are generating. Settlement in seconds, cost in fractions of a cent, no single sovereign controller, no SWIFT dependency, no correspondent banking requirement, censorship resistant by design. This is not marketing language. This is the technical specification of what the global financial system just publicly demonstrated it needs. The connection to XRP's price is not immediate, it is structural. Central bank pilots take years. BIS working groups take years. But the urgency has shifted from years to months in a way that is unprecedented in the history of this asset class. Watch the BIS quarterly reports. Watch the IMF working papers on payment infrastructure. Watch the language from emerging market central banks about digital settlement infrastructure. The signal is building in the institutional policy conversation. It will reach the market before the mainstream media recognizes it. The supply picture is not waiting for any of this. While all of the macro and legislative signals are developing, the on-chain mechanics are continuing their own trajectory independent of the external catalysts. Exchange supply is continuing to decline. This is not a weekly observation. It is a persistent, multi-month trend that is not reversing. The significance of this is something I want to take a moment to explain carefully, because this is the piece that most retail analysis treats as a footnote. Markets reprice when supply and demand relationships shift relative to what the current price reflects. Right now, the current price of XRP reflects the demand environment and supply availability that existed before three things happened simultaneously: the Hormuz shock and crypto's decoupling response, Morgan Stanley's final phase signal, and the Clarity Act reaching its most critical legislative window. None of those events have been fully priced into XRP yet, not because the market is inefficient in the long run, but because institutional positioning takes time, regulatory positioning takes time, capital rotation takes time. The supply is already compressing. The demand catalysts have not yet been fully priced. The gap between those two facts is where the structural move is building. When the external catalysts, legislative passage, institutional rotation, macro bottom, begin to resolve, they will be meeting a thinner supply environment than any of them encountered individually. That is the coiling spring mechanic completing. And unlike price predictions, this is something you can verify yourself by checking exchange supply data on any major blockchain analytics platform. The data is public. The trend is visible. The interpretation is structural, not speculative. What to watch? Precisely. Let me give you the exact indicators that tell you the sequence is progressing in priority order. 1. Equity market structure. You are watching for the final phase to bottom. The signal is not a green day. It is a sustained period of higher lows with declining volatility. When the Nasdaq stops making new lows for 15 to 20 consecutive trading days, you are likely in the base formation that precedes institutional rotation. 2. Senate Banking Committee procedural moves. Not the headlines, not the press releases, the committee calendar, the cloture vote timing, the statements from swing vote senators about timeline. This is where the real signal comes from, and it moves weeks ahead of the mainstream news cycle. 3. Exchange supply data. Watch XRP balances on major exchanges weekly. You are watching for the trend to accelerate, not just continue. An acceleration in the withdrawal rate, particularly around any legislative catalyst, is confirmation that institutional positioning is intensifying. 4. BIS and IMF language on digital settlement. This is a slow-moving signal with a long lead time, but the language shift from exploring to piloting to implementing is trackable in quarterly publications. The geopolitical shock has likely accelerated that language shift by at least 6 months. The next round of publications will reflect it. 5. ETF flow data. Daily ETF-related volume in XRP is a direct read on institutional demand that is present regardless of price movement. Watch for the baseline to shift upward. An increase in the daily institutional demand floor, even by a small percentage, has compounding effects when supply is simultaneously compressing. None of these require you to predict. They require you to observe. And the observation puts you months ahead of the investors who are watching price alone. The honest reckoning with risk. I said it in the last analysis, and I'll say it here because consistency on this matters. The destination is not uncertain. The timing is. Here is what that distinction requires from an investment posture standpoint. If the Clarity Act passes in this window, the 90 to 180-day institutional custody transition begins, supply compression accelerates, the repricing is structural and relatively fast. If the Clarity Act is delayed, the timeline extends. Organic XRP ledger utility growth continues. The geopolitical case for neutral settlement infrastructure continues building. The supply compression continues. But the institutional adoption catalyst is pushed out by years, not months. Both paths lead to the same destination. The difference is speed and volatility along the way. The investors who are positioned and who understand the structure hold conviction through the slower path because they can read the underlying data. The investors who don't understand the structure will interpret the slower path as failure and exit before the resolution arrives. That is not a commentary on price. It is a commentary on information. And the information advantage in this market right now belongs entirely to the people who are reading the structure rather than the headlines. Bringing it together. Here is where we actually are. The stress test is complete. Crypto passed. The decoupling that was building quietly for months showed itself publicly during the most significant geopolitical event of the year. The final phase signal from Morgan Stanley is active. Institutional rotation is not a speculation. It is the natural consequence of equities bottoming when alternative asset classes have demonstrated uncorrelated resilience. The legislative window is open. The Clarity Act has never been closer to passage. The calendar pressure is real, and every serious participant understands it. The supply compression is building from multiple independent sources, and it is not waiting for external catalysts to continue. And the geopolitical crisis has delivered the single most effective public demonstration of why neutral digital settlement infrastructure matters. To every central bank, finance ministry, and treasury official simultaneously. The setup I described previously was not the beginning of the move. It was the conditions that make the move possible. What happens next is the move itself, and it will not announce itself with a headline. It will show up first in the data, in the exchange supply numbers, in the committee calendars, in the equity market structure, in the policy language from institutions that most retail investors never read. The investors who see it coming will already be there. That is the only edge available in this market right now, and it belongs to anyone willing to read the structure instead of the price.